The fastest way you can live off dividends, according to Warren Buffett. Investing in dividends is considered to be the smartest way to generate monthly passive income. Unfortunately, one of the biggest problems with this approach is that it often requires decades to earn any beneficial outcomes. But what if there were some techniques to accelerate your retirement from dividends, allowing you to enjoy early retirement? How do we go about it? In today's video, we'll talk about the fastest way you can live off dividends and what Warren Buffett, the most famous billionaire investor on earth, can tell us about it. Also, if this video helps you, please leave a like and subscribe to our channel so you don't miss any of our videos. The first thing that you should know is that investing in dividends is a plan that entails purchasing shares of corporations that distribute returns on that investment regularly. The appeal of this move is that it provides a non-taxable source of income that is not reliant on the ups and downs of the stock market.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
Instead, the investors received consistent payouts based on the business's profitability, which may result in a more steady return that might be very desirable when planning for retirement and also for rainy days like the current bear market. One of the most renowned advocates of dividend investing is Warren Buffett. This disciplined approach has helped him achieve incredible success as an investor, maintaining his spot in the top 10 richest men in the world, fending off competition from tech entrepreneurs and electric car manufacturers. His methodical approach has been highly effective in his extraordinary success as an investor. So, for those wishing to continue in his footsteps, you're an excellent company because dividend investing is a terrific strategy to follow. So, where do we begin? First off, note that the sum of money you'll have to invest to rely on dividend income depends solely on your way of life and how much you spend compared to your income. Just as we explained in one of our previous videos, you should not be earning minimum wage and living like the Kardashians. According to the United States Bureau of Labor Statistics, the average American spends roughly $67,000 annually. If you do the math, it's about $5,600 per month on average. Depending on how far above or below these figures your income is, you would have to adjust these figures to fit your unique situation. If you're able to be frugal with your spending, you will find that a modest investment in dividend stocks can generate enough income to cover your basic living costs and allow you to take some cash off for that boat cruise. The larger your investment, the more money you make. But if you yearn to retire with dividends as soon as possible, you could be amazed at how rapidly you could accomplish this. For the benefit of this video, we'll work off a $40,000 income target a year, which ought to be plenty for most people's basic needs. Dividend investing is fundamentally a long-term plan that calls for patience and discipline. However, one of the main methods you can employ to speed up the process of surviving on dividends is done through covered call ETFs. As Warren Buffett would say, price is what you pay. Value is what you get. Covered call ETFs enable investors to earn money not just from dividends payment, but also from the rise in stock price. Besides investing in stocks, the ETF also writes call options on the same equities for supplemental income. Call options give the buyer the right but not the obligation to purchase a stock at a specified cost within a specific time frame in such a way that when the ETF sells call options on the stock markets in its portfolio, premium income will be distributed as further dividends. If the stock price surpasses call option levels, there can be capital gains. That can also be achieved since the ETF is going to have to sell those shares. The yields on many ETFs are quite appealing indeed. Top ETFs yield double-digit returns. This is a lot greater than the yields of conventional dividend stocks. Take a look at the 12-month yields on these ETFs. QLD gives an annual return of 15.96%, while XYLD and RID at 14.18% and 13.76% respectively. These ETFs' advantages include the fact that they provide income from both dividends and option premiums. That's how it provides a more stable stream of passive income.
And there are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums which they earn.
However, as wonderful as they sound, it's important to make sure you have all the information you need on both pros and cons of these ETFs. They do come with several risks. The options may expire, or the cost of the stock could decrease in value. Both instances are not uncommon in the world of investing, so you have to keep your eyes peeled for what you want. Just as the Oracle of Omaha once said, if you aren't willing to own a stock for 10 years, don't think about owning it for 10 minutes. So how much would you need to invest to retire with covered call ETFs making 40 grand per annum? Well, if you wanted to make $40,000 from covered call ETFs each year, then, based on current yield levels, you would need somewhere between $250,000 to $290,000 invested right there. For dividends of that size, it's not exactly what we would call excessively awful, is it? Particularly when you compare them to conventional dividend stocks, where about $2 million would be required to achieve the same level of income. Let that sink in. High-yield real estate investment trusts. The second method you can employ to live off dividends more quickly is by investing in high-yield real estate investment trusts with a high yield, also called REITs. REITs are companies that invest in income-producing real estates, such as shopping centers, office buildings, apartment complexes, and apartment buildings. The billionaire investor once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Real estate investments trusts typically pay out a considerable proportion of their income as dividends to investors. Some of the top dividend-paying REITs include the Blue Rock Residential, Apollo Commercial, and Omega Healthcare. These REITs have a long track record of steadily rising dividends that give a consistent flow of income to their investors. For example, CBRE Investment Management claims US REITs provided an annual average return of 10.8% over the last 20 years. These yields can fluctuate because of a good number of factors, including occupancy rates and current market circumstances. But the advantage of purchasing REITs is that they have the advantage of offering better yields than standard stocks. Nonetheless, they also include higher risk, given that these businesses are more susceptible to being impacted when the economy dives. Sad, but it's true. Doesn't mean the risk-to-reward ratio is not worth your attention. As Warren Buffett would put it, risk comes from not knowing what you're doing. That would mean we have to study a lot. In that case, how much would you need to invest to retire with REITs if you wanted to earn $40,000 a year from REITs? Simple. Just commit about $400,000. Currently, this is assuming a yield of 10%, hence the actual figure will rely on your decision to diversify into several REITs or simply put all of your money in one.
Intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms.
The ball is in your court. A realistic way to retire on REITs is by making steady weekly investments and reinvesting the dividends up until you get the portfolio volume you desire. Remember our snowball rule? Check it out in one of our previous videos. That's how we understand what the billionaire investor means when he says the most important quality for an investor is temperament, not intellect. So with proper discipline and persistence, it's without a doubt that it is possible to achieve financial independence through dividends investing in 5 to 7 years at most. Yet this is what most people miss. When you invest in dividends, you must always have a plan. That's why whenever the veteran businessman Warren Buffett is asked of his rules, he never fails to mention these two. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. You have to be fully aware of the amount in full, what you require, and your objectives. This will enable you to select the top option for your portfolio of equities and make sure that over time, you stick to your plan. To do this, you must calculate your living costs and make sure your investments produce sufficient income to shield them. Perhaps you get by with less than $40,000, or maybe you have a family and will require extra resources. Wherever you find yourself on the scale of income, know that it is possible to achieve financial independence. It's worth repeating the fact that contrary to conventional dividend stocks, REITs and covered call ETFs typically pay monthly to their shareholders. This is a huge part of what gives them both an even greater favorable selection among potential investors hoping to make a regular living from the stock exchange. You now know about investing in companies that consistently pay dependable dividends can be an excellent means of achieving fiscal independence. Whether you select securities, ETFs, or REITs, it's crucial to understand the dangers associated with each investment. That's why you should take up a plan that takes your risk tolerance into account. With a little perseverance, you can be well on your way to financial success, gaining independence via investing in dividends. As Warren Buffett, CEO of Berkshire Hathaway, would always say, the most important investment you can make is in yourself. So, what would you rather invest in? Do you favor REITs or covered call ETFs? Let us know what you think in the comment section below. Don't forget to like, share, and subscribe to our YouTube channel for more amazing content. See you at the next one. Bye for now.